So welcome. So what we're going to do now is look a little bit at the structure of the Fed and sort of get a sneak peek behind what it does and how it does it, because this gives some insight into the larger thinking of how they attack policy and what it means for the central bank to exist. So some of the questions that we're going to think about, as I just mentioned, are, first of all, why does the Fed exist? Secondly, why is it designed and structured as it is? And we'll see how the details of that work out. How does it operate and interface with the government? As you'll see in another chapter, there's a very clear distinction between the Federal Reserve and the fiscal and political arm of the government for very good reasons. And the last question is thinking about the independence of the Fed and how autonomous it is as a policy institution. And on top of that, why that might be important. So if we look at the origins of the Fed, central banks in the U.S. has a very checkered history. There's several attempts to have central banks in the U.S., and they fell apart at some points. Through much of the 1800s and early 1900s, there was no central bank in the United States. And as a result, there was a series of banking and financial panics and broader financial crises and economic instability. And so it got to the point where the public and, by extension, politicians got fed up with having to deal with these recurring financial crises. And so eventually in 1913, Congress established the Federal Reserve System through the Federal Reserve Act. And one of the interesting features of how this process occurred is primarily the way in which the public and the politicians had a fear of centralized power. And so that's one of the peculiar ways in which the Federal Reserve is structured is due to the fear of centralized power, primarily based in the East Coast, in the Washington, D.C. and New York areas, and also in terms of thinking about the moneyed interest and how powerful moneyed interest can influence policy in beneficial ways. So when Congress established the Federal Reserve System in 1913, it did so with a mind towards isolating it from these various influences. So if we look at the map of the Federal Reserve, again, this gives you an idea of what the Federal Reserve System looks like. There's 12 districts, and you can see within those 12 districts there's a headquarters. And what we'll see is that each of those 12 districts, there's a president, and there's a whole system within each district. The most important thing to take away from this is you can see, again, that diffusion of power. Here, the diffusion of power is delineated along geographic lines so that the way that this map was drawn up at the time in the early 1900s, this really represented a balance in terms of the population and in terms of dividing industrial and economic might. And so that's the reason why you see the smaller geographical footprints of the central banks in the East, and then as you go west, the geographic size of those things gets larger. And so the key thing to think about in terms of the structure of the Fed is it diffuses power along geographic lines, it diffuses power along political lines as well. And so the way it does that is, as we'll see, Congress created the Federal Reserve in such a way that it could operate outside of the government control in many ways. So in a lot of ways, it acts a little bit like a private enterprise, but it also interfaces with the government in a lot of ways. So it has some features of both a private enterprise and a government entity. And then the third piece of the puzzle here in terms of thinking about the design is that it also diffuses power between bankers, business people, and the public. And to see that, we can see the structure of the Federal Reserve System. We have member banks here, so they're part of this broader system. So commercial banks are members of the Federal Reserve System. Not all commercial banks are chartered by the Federal Reserve. Some are by states, but all are controlled in terms of regulatory oversight by the Federal Reserve System. So within these member banks, in each of these districts, you have a board of directors. And the board of directors, there's 9 of them. So those are composed of people in business, they're composed of bankers, and they're composed of everyday people. And so that was designed deliberately, again, to diffuse power along these various lines. So each of those 12 regional districts has 9 directors, and they're split along business, bankers, and sort of the broader public in that regard. So the Federal Reserve district banks, they have a president, and so with each of these, within each of these districts, there's a president, and the president is appointed by the directors within that regional district. And it turns out that that's an important part of this broader monetary policy process because the presidents of each of the districts get to participate in the monetary policy process. And so in addition to giving input into monetary policy, district banks do a lot of other things. They clear checks. So if you write a check in one bank, in one region of the country and cash it in another, then those regional central banks work together to try to make the funds flow through the banking system. They issue new currency and remove old currency. So if currency gets worn out over time, they replace that. They execute discount loans to district banks. So among the banks within their district, they're able to loan money directly to those banks, and they can also control to some extent the interest rate that they charge those banks. They have oversight of the activities that occur within their district. They monitor and collect data on local business conditions, and this information becomes part of what's referred to as the Beige Book, which the Federal Reserve uses as a basis for thinking about what policy should be done. So that is a summary of local business conditions across a lot of all of the regional Federal Reserve banks. And then, of course, they do a lot of economic research and participate in the monetary policy process. So this gives you an idea of thinking about the interconnected nature of this, and it might look pretty complex, but the most important part of it is sort of the broader district banks, but more importantly, thinking about the Board of Governors, the Board of Governors and the Federal Open Market Committee. So the Board of Governors really is the figurehead organization of the Federal Reserve System. So there's 7 members in total on the board. It's headquartered in Washington, D.C. All of those 7 members are appointed by the president and confirmed by the Senate. So it's a political process to get the people on the board. And they generally serve staggered terms. Those terms are 14-year terms that are non-renewable. In some cases, they can serve more than that if they're filling in a part of a term from another person who is departing the board. And so that's by design so that people on the Board of Governors span multiple presidencies and multiple political cycles. And that's to help insulate from the potential for political influence in the policymaking process. It turns out that the chairperson, the chair of the Federal Reserve, is one of those board members, and they're appointed every 4 years by the president, and they can be renewed every 4 years through this process. Typically, if the chair is not renewed for another 4-year term, technically they can stay on as a member of the board, but tradition dictates that they step down. So in terms of the board functions, there's a lot of things that they're involved in. Again, there's sort of the figurehead umbrella organization for the entire Federal Reserve System. Obviously, they participate and vote on monetary policy actions. So the board, along with the broader FOMC, contributes to thinking about and deliberating on monetary policy. They set reserve requirements. They control the discount rate through a review and determination of district bank setting. So it turns out that regional district banks can actually control and have differential discount rates. They set margin requirements for securities purchases. They approve and advise on bank mergers, and they also have a huge economic research agenda as well. And so the other piece of this puzzle here is the FOMC. And it turns out that they are the main policymaking arm of the Fed. And so they are a crucial part of the monetary policy process. So the FOMC, the Federal Open Market Committee, meets every 6 weeks to deliberate on monetary policy. And so the outcome of this is the members of the FOMC vote on a monetary policy, which can include changes to things like the Fed funds rate, changes in its asset purchases, which we've seen more recently is a big part of the Federal Reserve's monetary policy. And it can also bicker with wording of the policy statements. And of course, they vote on this as a committee in terms of what the policy statement is that's released to the public, and what's referred to as forward guidance as a policy tool. And so in the bigger scheme of things, the FOMC, the Federal Open Market Committee, is composed of the 7 people who are on the Board of Governors, okay? The New York Fed district president always gets a seat at the FOMC. And then of the remaining 12 district banks, that's 11 of those, right? There's 12 total. So the remaining 11 district banks, you have 4 people who rotate in and out through the FOMC. All 12 presidents plus 7 on the board get to sit in on the meetings and give input into the monetary policy process. Only the FOMC, which are the 7 on the board plus the 5 selected from the district banks, get to actually vote and ratify the monetary policy. So one thing that you might be thinking about here is, why is the New York Fed so special, right? So you have these, the New York Fed always has a seat at the FOMC in terms of voting, but of the 11 remaining districts, they all have to rotate in, okay? Well, there's a good reason for why the Fed, the New York Fed in particular, is always at the table to vote and participate in the policy process. So first of all, the New York Fed executes open market operations. So when the FOMC decides on a policy, they can't just will it to happen, okay? What they do is they call up the trading desk at the New York Fed, this what's referred to as a system open market desk. And the New York Fed, the trading desk, actually executes the policy. And so they will buy or sell bonds or other assets in order to achieve the policy prescription mandated by the FOMC's deliberations. So they do that, and of course, because they're down at Wall Street and they're in a large concentration of banks and brokers, they have a very good pulse on what's happening in the banking and financial sector. In addition to that, they manage the Fed's foreign exchange holdings. They have the largest holdings of gold reserves in the world. If you've seen the one Die Hard movie, you'd know that, of course. And then they also hold a seat. They're the only regional Federal Reserve Bank that holds a seat at the Bank for International Settlements. And again, it's for all of the reasons that we talked about. So they're an important part of the Federal Reserve System, and they always deliberate on policy. And so not only is the New York Fed an important part of this process, but the chairman of the board, of course, is also very important and powerful. And so that's because of a few things. So first of all, they can set the chairman can set the agenda in terms of what types of things are talked about and in what order. They can set the tone for the meetings. They can sort of influence behind the scenes the committee members in terms of their thinking. And they can bring consensus to a particular area. They are the spokesman for the Fed, so they garner a lot of attention. In general, the Federal Reserve is a very powerful institution because they have very powerful impacts on the economy. And so for that reason, because the chairman is the spokesperson for the monetary policy making arm of the Fed, people listen, okay? And then lastly, the chair is responsible for reporting to Congress on monetary policy. And so there's a lot of attention, again, garnered to what the chair is saying. So with that, one of the things to think about, again, in terms of going back to the structure of the Fed and why it's structured the way it is, one of the reasons why is because Congress wanted to bring some amount of independence to the Fed to try to isolate it from political and moneyed interests. And so there's a good reason for this. Again, having an independent Federal Reserve allows for the need to conduct prudent policy for long-term stability, okay? So in particular, as I mentioned before, the Fed and so the central bank can have a really powerful impact on the economy. And so you can imagine the amount of interest by financial markets and others in terms of being able to predict or influence policy in some way. And so for this reason, there's a need for central bank independence. So there's 2 types of independence. There's what's referred to as instrument independence, and there's what's also referred to as goal independence. So the instrument independence basically means that in order to achieve its goals, the Fed has to push and pull certain types of levers, right? So with instrument independence, the Fed has complete autonomy in some sense in order to decide, well, how is it going to achieve its goals? In the case of the Fed, they conduct open market operations, they manipulate the Fed funds rate, they conduct asset purchases. So all of the things that they do in terms of the policy levers, it has pretty much full autonomy to do. So for the Federal Reserve, it has a great deal of instrument independence. The flip side of that is looking at the goal independence case. The Fed has a bit less in terms of goal independence. When Congress established the Fed, it was given a mandate of essentially, or at least an updated version of it, it is given a mandate of price stability and maximum employment. So whatever the Fed does, it has to do it with a mind towards trying to get price stability and maximum employment achieved. Okay. Now those are somewhat vague goals, which gives the Fed a little bit of wiggle room to try to interpret what price stability means and what maximum employment means. Okay. It's widely viewed as low stable inflation on the price stability side, and maximum employment is widely viewed as a reasonable unemployment rate somewhere near the natural rate of unemployment. So on both counts, there's a great deal of independence in terms of what the Fed can do along these dimensions. But there's other ways in which the Fed is relatively independent. So for instance, through the political appointment process, as I mentioned, the Fed Board of Governors are appointed to 14-year non-renewable terms, which span multiple presidencies and therefore insulate it from the political process and the potential for generating political business cycles. It also has budget independence. So all of the assets that the Fed holds, it earns returns on those assets. And that's how it funds basically the entire budget for the Federal Reserve System. So it holds bonds which earn returns on those bonds. And again, that's a way of managing the expenses. So the Federal Reserve is completely disconnected and not beholden to the fiscal side of the government in terms of its operations. It can operate completely independently because it earns returns on its assets. And the third aspect of this is that the Fed has relatively minimal oversight from the government. So the government has a minimal ability to formally audit the policy prescriptions that the Fed comes up with. There's some ability for it to audit the expenses and those kinds of things, but it's relatively small. So the punchline here is that there's a great deal, the Fed has a great deal of independence, and the broader issue is thinking about, well, how independent is the Fed, and really should it be that independent? Well, first of all, it isn't completely independent. So as I said before, Congress created the Fed. So in theory, Congress can destroy the Fed and basically make it disappear. It's not going to happen in practice, but in theory, the Congress can always threaten to change its mandate or change the way it operates. As I said, the Fed budgeting and expenses are subject to some scrutiny, but not a great deal. The Fed has to report twice yearly to Congress. And so it can't just simply do whatever the heck it wants to do and get away with it. It at least has to face the scrutiny of the public and policymakers, which can often bring very harsh questioning to the Fed. And on top of that, a lot of, if not most of the Board of Governors members don't serve full 14-year terms. They often leave after a few years because the private sector is very lucrative, or maybe they're academics and they just want to get back to the classroom. And so as it turns out, there's a lot of turnover, and therefore it's not inconceivable for an 8-year president to appoint 3, 4, 5, 6 people to the Board of Governors on a panel of 7. And so that, again, can generate a lot of sort of political, a slight amount of political bias in terms of the thinking of the board. And since the chair is renewable every 4 years, again, if the chair of the FOMC wants to continue on as the chair, then there might be some implied pressure by the chair to be beholden to some of the views that the president might hold. So the punchline here is that there's some arguments for Fed independence. The basic argument here is such that you don't want the Fed to be too closely tied to the political or the fiscal side of the government. And the reason why is because the government may then force the Fed to create extra inflation to try to drive the unemployment rate down. It may force them to try to do policies that might have short-term gains but have much broader long-term consequences. So by its design, the Fed is really trying to, it's designed in order to think about long-term stability rather than short-term gains. And it turns out that empirical evidence really shows and backs this case up that central banks that are more independent tend to have better economic and monetary policy outcomes. That is, lower inflation on average. And that's a pretty strong result. And it turns out, too, that politicians, for the most part, aren't really economists. And so if you have politicians who are involved in the monetary policy process, making complex decisions or weighing in on monetary policy decisions, these are pretty complex decisions that are to be made. And so in most cases, politicians, elected officials, fiscal policymakers aren't well suited to be able to make these types of decisions. And the other more practical aspect of it is that politicians may simply like the Fed to be independent, because if the Fed is that independent, then when the economy goes south, then politicians can blame the Fed for when things go wrong. And so that makes the politicians feel good and look better in the eyes of the public in some cases. Some arguments against independence. Well, first of all, there's no oversight or auditing of the performance of the central bank. And that's something that's been more apparent to detractors in recent years. And so, again, that's by design, that if you have people fooling around if you have politicians who are fooling around and interfering with this independence in the monetary policy decision-making process, then it can, in some cases, unduly influence policy in ways that can have undesirable effects. And the flip side of that, too, is that in a lot of ways, the entire monetary policy process, it feels very undemocratic. In a democratic society, we'd like to have open and free discourse on these issues and everybody be able to weigh in equally. But in the case of monetary policy, again, it's important to understand that monetary policy should be conducted to achieve long-term gains, which sometimes can be at the expense of shorter-term goals that might feel good at the time. And so there's always a temptation to want to do something in the near term without thinking about the long-term consequences. And so in some ways, too, the people point to the fact that the Fed acts under this theory of bureaucratic behavior. And the idea is simply that, the Fed isn't in it for the good reasons of keeping the economy going and stable, but rather it's in the game, so to speak, for its own reasons of ensuring its power and maintaining its footprint of what it does. And so there's some examples of this. For instance, it might try to protect its budget. It might fight to maintain autonomy. It might protect its jurisdiction over the banking system and regulatory authority. And it might avoid conflicts with lobbies, which can sort of add more scrutiny to the process. But it seems somewhat less plausible that the Fed acts solely in this sort of theory of bureaucratic behavior at the complete expense of really doing what it needs to be doing, which is keeping in mind the long-run objectives of price stability and maximum employment. So in this landscape of thinking about independence, the question is, well, should the Fed be independent or not? And the answer is really there's a delicate balance between, on the one hand, the accountability in a democratic society where we want to make sure that there's checks and balances and that the Fed is doing the right thing. But on the other hand, there's a powerful argument that suggests that the Fed and central banks around the world should have a great deal of independence, primarily to insulate itself from the political influences and from the fiscal side of the government. Because at the end of the day, if it doesn't, then we can see inflation expectations rise, and that can make the central bank's job even that much harder. And so if we look at the landscape of central banking, what we've seen is over time, central banks have become more independent rather than less independent. And so that in some ways is a proxy for answering this question that most people recognize the value of central bank independence. Having said that, there's still a lot of variation in central bank independence, even among the most advanced nations around the world. Thank you.